Okay, welcome back to our discussion of relative strength. Now we're going to get into one of my favorite ways to approach relative strength. So hold on to your hats. This is something I use all the time and I love it. Okay, here's what we're going to do. First of all, I'm going to back up a little bit and just show you a couple things you can do. Now, first of all, you'll notice that we have just two markets. And that's what we're going to do now. We're going to just be comparing two markets. So this white one, the thick white one, is the S&P. Okay, and then the magenta one will be whatever other market we're going to compare it to. So the S&P is going to stay the same. If you're using TradeStation, whichever market you want to remain constant, in this case the S&P, that has to be data input number 2. Okay, because as we type in new symbols, it's going to change number 1 automatically. So therefore you want the S&P or whatever benchmark you're going to use to be data number 2. Alright, so we can do a couple things here. One we've already discussed. We can go through various markets, compare with the S&P, look for trend line breaks and that sort of thing. This is 3 months back. Another thing we can do is we can go, say, 1 week back. And now we're going to get something very different. We're going to start to see just within the last week. It's just like when we looked at, well, it was both in StockFetcher and also in StockCharts.com. You could go back and see the change within, you know, the last day, the last week, last month, 3 months, 6 months, 12 months, 2 years. So you could do the same thing here, but it's just graphed. And so the starting point is going to be 1 week ago. They both start at 0% change. I put a horizontal line there right now. And, you know, so this one, what was this again? IYM. So this one started down. It had less relative strength in the S&P, and now it's got more, so these things can change pretty quickly. So I just go through a couple here so you see what it looks like real quick. Okay, this one has stayed pretty much the same following it, but then did not move up as high as the S&P, so that's showing relative weakness. And the symbols I'm using are up here. Okay, these are all going to be exchange traded funds. Okay, this one, emerging markets, is showing a little stronger movement than the S&P. Internet holders, definitely stronger. Financials, definitely quite a bit stronger. Okay, steel, stronger. Natural resources, ouch, weaker. Okay, so that's pretty much it. You just go through and you can do this again over whatever time frame you like to do it, and just do it on a real short-term basis like this. Okay, so now let's go back to 3 months. I tend to do the 3 months, and then what I do is I put an indicator on here. Let's actually choose a different market. Okay. So in TradeStation, the indicator is called spread dash diff. Alright, and it's very basic. Again, nothing that I invented. It's already in TradeStation for you. And I'm sure it's in other charting platforms too, under various names. It's not in all of them, but it will be in some. And if you don't find it in yours, then you can either go into the forums and see sometimes people create indicators for various charting platforms and post them in the forums. Call your support line for your charting platform and see if they know if it's available. Again, it would only be available if you can plot two different symbols on the same chart. And if not, then basically you won't be able to use this particular indicator. You just have to do it the way that I already showed you with stockcharts.com. Oh, so let's activate that indicator now. All right. So it's a very simple concept. All it does is it plots the spread between these two markets. Okay, so like here, when the spread, and there's no spread between the two markets, it reverts back to 0. And basically all we're going to do, you don't really need to understand the indicator much. All you need to do is really to use this indicator for, as I mentioned before, trend lines and horizontal lines. So we're going to put, instead of doing it on the line price charts themselves, we put them on the indicator. And I have found that this is much easier to see, and it shows you when there's a shift of relationship between these two particular markets. So we can do that. We could draw a little trend line here. So if you draw trend lines now, that's a more aggressive entry. If you draw it above a previous high, that's a more conservative entry. And again, actually I shouldn't say entry, but signal, because we're not going to use this as our entry. We are not trading off this indicator. We are merely using this to try to find a shift in relative strength, and then put it into a watch list and look for an entry saying, essentially what it's doing is it's helping you to find which markets do I want to trade. It's not helping you to time those markets as specifically and accurately as the cycle indicator does. It's just like the scanner. We use the scanner to find markets we want to trade. Well, this is another way of finding stocks to put in your watch list. Assuming we go long, we would expect that a market that is outperforming the S&P is going to continue doing that, and will give us bigger returns than if we just traded the S&P or any stock we just happened to find on a scanner, or whatever our favorite stock happens to be, or whatever the latest guru is saying, oh, get this stock, get that stock. Instead of doing all that stuff, we're saying, I would like to outperform the S&P. And there's no guarantees that you're going to do that, obviously, but this is one way to attempt to do that by looking for some early indications that a particular market is starting to have a relative strength compared to the S&P. Now, having said that, believe me, it is very possible for it to gain a relative strength over against the S&P for a very short period of time and to lose it very quickly. So there is no guarantee that that is going to sustain. But we're trying to find we're trying to get in when the market we're watching looks like, well, and not even looks like, but really is starting to gain a relative strength over against the S&P, and then pray and hope that that continues, realizing the whole time it may not continue, and that's why we have our stops and so forth. Okay, just like here, it's a good example. So here, okay, both of these markets are going down, but the magenta line, the exchange traded fund we're trading, is underperforming the S&P. Therefore, this line goes down. Then it starts to come up, and it actually matches the S&P. So in a way, it's actually outperforming the S&P because it catches up from down here, and it comes back up. to match it. So it had to regain more distance, more percentages, and therefore it's not just equally performing, but from here to here it is outperforming the S&P. But as you can see, that is short-lived, and then it starts underperforming once again. Alrighty, and then here too, it's underperforming, but just slightly. You know, basically it's moving pretty much in sync with the S&P, isn't it? It's just below it a little bit, and so this is just gradually going down, and then it comes back up, and it comes all the way back and almost touches it here, and that's creating the performance that's outperforming. But unfortunately it can't really maintain that. But now, see again, the distance here, it's closer than the distance here between the two lines, and that's why you get this line going up and you get this line going down. Okay, let me go through several exchange traded funds here. Again, I primarily do this with exchange traded funds, but you can do it with stocks and futures. You can do it with Forex if you want to see which Forex markets are performing the best. It's actually a really good idea. Because there's so few Forex pairs, you might actually want to use the other technique, because when you use this indicator, you can only plot two symbols at a time. So, okay, this is biotech. Again, all the symbols are going to be up here if you're interested. So biotech this is very, very important to look at. It gets a little tricky. Sometimes people have a little bit of a hard time reading this, so I'm going to help you with this. Okay, biotech is the purple line down here, and the S&P is the white one. So it looks like biotech is underperforming the S&P. Actually, it isn't. It's outperforming. It's not underperforming. Why? Well, they're both going down, but notice how the lines are getting closer together, whereas here they're really far apart. And that's the point. The S&P is going down more dramatically at a faster rate than biotech. So therefore, biotech has a relative strength that's positive, and therefore this line goes up. So they're both bearish. See, that's the point, is that it's easy to look at this indicator and say, okay, here's a high, so maybe I should, start looking for a long somewhere in here. Like on this retrace or something, look at a regular chart and see if that's a good entry. But not necessarily. Just because the indicator is going up does not mean that you're in a buying situation. In fact, you could be looking at a very bearish market. This only tells you about the relationship between these two, but this can be going up. When both markets are going down, it's just that the market that you're considering is going down less than the S&P. Okay? So, kind of retraces here a little bit, and then again, we get another move up here. Well, what happens? Here we see these lines cross. Now, biotech is actually above the S&P. And that just means, again, it's going down a smaller percentage than the S&P is going down. And then the S&P kind of catches up, and, they're basically roughly pretty much the same here, which is why this is pretty sideways here. So, but this would be an interesting one to watch right now. And because we've got a consolidation pattern here, draw a trend line there. Let me clean up the chart a little bit. This would be an interesting one to draw a trend line there, and maybe a horizontal line there. And look for a break and see. We don't know, maybe biotech will outperform the S&P, maybe it'll underperform it. But, you know, you put it on your watch list and it's something to look for. This is one of those times. See, because basically, again, I'm looking for, on this indicator, I'm not, when the market is like here, it's kind of too late. I'm looking for the shift. I'm looking for it going from underperforming to overperforming. I'm looking for that juncture right there. Well, we could, so basically, I am looking for the indicator to either be going sideways or down. I'm not looking to trade when this indicator is going up. Sideways or down. That's it. And that's what the value play is all about. When I say that I'm looking for a value play on these relative strength techniques, that's it. Trying to get it when it's still, before this thing is really taking off, before it's outperforming the S&P. I'm looking for when it's just equal to or even underperforming the S&P, and I'm looking to catch that, you know, that very first move when it starts outperforming in the first trade we get off of that. Now, sometimes these things go to the moon and you don't get a real good entry on them. In fact, sometimes you don't get any entry on them because when they shift, they just go whew, and they take off like a rocket. And so, oh well, you know, you didn't get that one. We have to keep to our rules. Just keep watching them, put them in your watch list, and the ones that do provide valid setups, those are the ones that you trade. That's all. Very simple. Okay, emerging markets. Again, now this is an interesting one to watch right now because we've got a nice little trend line pattern here, and it's just starting to break above this little one here, maybe. So, you know, this is very, very, very much what we're talking about. These are pretty equal right now, and if we can get a big move like this, looking into something down here to buy could possibly be really great. Okay, internet holders, no, this is too late. The time that I would have wanted to have bought this would be, you know, the break of this trend line down in here, or again the first retrace after it breaks the trend line. So that's we're not going to add that to our watch list. Financials, again, you can look at a chart on this and see, but you know, this trend line's been broken. That's okay. Actually, this one, yeah, you could look at this because this high has just been broken, and so that first retrace down here, if this thing continues to go up, yeah, that timing is good. So we could put that one on our watch list, XLF. Steel, possible, but right now it's going to have to break for us to get interested in that. And here's a very good point. Let me, there was actually a better example before. Let me find a good one here. This one's a good one. Okay, here's a really important point you need to know. So let's say you drew a trend line here, and you're looking to buy, and then you draw a trend line here, and then you say, wow, we get kind of a nice head and shoulders pattern here, we get this break, we get this retrace, even this high maybe, you know, so you're looking to either buy here or here. Look at a regular chart, and is that a good idea? Well, I mean, that's the concept, but look what happened. I mean, here's your, basically the two markets move pretty close together, and so it just kind of goes sideways a little bit lower low here, because the international markets do make a little lower low than the S&P there. But bottom line is, no, it doesn't work. It ends up making lower lows, right? International market goes down to here, S&P goes down to there. Both of those lows are broken. So this technique alone, like every other technique, like every other indicator, this indicator alone is worth what? 0. Right? It's one more piece of evidence. It's just one piece of evidence. But you don't convict someone on one piece of evidence. Right? You need 2, 3 witnesses at least. We like 4 or 5 witnesses before we make a move, before we're going to risk our money. And the point is, you know, the market's been in a bearish market this whole time. So yeah, it made lower lows. And just because the internationals started to finally pick up and get a little bit of relative strength going, again, as illustrated before, does not mean that you should be buying. It just simply means that, okay, now we're seeing a little shift between these two markets, but they could still both be going down. And you could be in a bear market. So, bottom line is, you want to be looking at the overall market, S&P, NASDAQ, Dow, so forth, and ask yourself, where are we in the structure of that? Where are we? Is this a structure that I would be interested in buying at all? And if not, well, you know, then I'm probably not even going to be looking at this technique yet. I always have it up, so it's always there and I always see it. But unless the other market that I'm looking at is so different, and that other market, so for example, let's talk about that. Most equities are going to trade roughly the same. But sometimes individual sectors or industries really do take on a different price pattern than the S&P 500. So look at that and say, oh, well, okay, S&P 500, I wouldn't trade now, but this other industry, wow, it's got a whole different price pattern, and, you know, this is actually in a good tradable structure right now. Or you might be trading something that doesn't correlate, like bonds or agriculturals or, you know, commodities of some sort, gold, currencies. And so in that case, you know, look at those individual markets, look at those charts. You always have to look at those charts and ask yourself, is this the, you know, is this at a time in the structure of the chart when I should be trading this at all? Okay, so very powerful technique, and I think if you watch this for a while, you'll come to love it as much as I do and find it as helpful as I have found it and as profitable as I have found it. Whenever I think, okay, or somebody asks me, you know, well, the golden goose is outperform the S&P. That's the benchmark of all money managers. Can you outperform the S&P? The vast majority don't. Not easy to do. I'm not saying you're going to do it, but this is the technique that I use to help do that. And again, doesn't always work, but it certainly gives you a running shot at it.